Three stocks have 52-week lows. Could they be an opportunity to buy? Shopify, Tyson Foods, 3M. The reason I like looking at stocks at 52-week lows is I'm a value investor. I want to find things that are cheap. So a good place to start is when stocks are falling, when they're hitting 52-week lows. Does that mean you should buy them? Absolutely not, guys. The analogy I always give is if my house is worth $500,000 and I ask $10 million, nobody buys it, I discount it to $5 million. Someone might say, hey, it's 50% off. That's a good deal. No, it's still worth $500,000. Don't overpay just because stocks have fallen. But that's why we look at our 8-pillar process to understand the fundamentals of a company. So let's go check it out. First stock, Shopify. If you have our software, by the way, please follow along on this. So I just type in Shopify here. It's up a little bit today to start. Shopify is at $35 a share. Its high was $176, and it's a little bit off its low of $29 a share. Guys, in the last year, it was at a high of $176, and now it's at $35 after coming off of 30. When I guarantee you go look at our videos in the past about Shopify, you will see us saying, hang on, pump the brakes here. Long-term value matters with fundamentals in a company. If you pay a reasonable price for a company and over time the profit goes up, your value will go up. If you overpay for a company, like Intel, Cisco, Micron, those other companies back in 2000, even though the revenue and profit are 2, 3, 4 times larger, stock price is still lower than it was 22 years ago. Okay, so let's go take a look at our 8-pillar analysis of the companies. This 8 pillars tab right here. So the first pillar, guys, we want the 5-year PE on the company being under 22.5. It's 628. Oh boy. Okay. Pillar in the 5 PE in the last year, not applicable. Why? Because it lost money. So the 5-year profit margin is 2.7, but last year's profit margin, negative 38. Pillar number 2, we want the 5-year return on invested capital being greater than 9%. It is 1%, another X. This tells me they're not reinvesting their capital very well, but this is a growing company that's probably spending a lot of their cash flow out of there, so that could be the reason. Pillar number 3, income. We want revenue growing over the last 5 years. So we go to the income statement, $853 million to $5 billion. Holy cow. 6 times more revenue. That's incredible. Pillar number 4, we want net income growth over the last 5 years. So we scroll down just a little bit. They lost $52 million. Last year, they lost $1.9 billion. Ouch. That's a huge loss. Why is that? Let's scroll up just a little bit. They had a $1.75 billion write-off in other income and expenses. So you need to go understand what that was. Still lost $150 million without that, but that's a huge number. Pillar number 5, we want shares outstanding either staying the same or decreasing. Why? Because we don't want to be diluted as owners. Okay, we don't want the company to say, hey, thanks so much for being an investor. You own less of the company now for sticking along with us. But it's very common amongst high-priced companies, and I don't blame them. They issue shares to fund their business. 943 million shares outstanding at the end of year 6, 1.26 now. That is an X. They've increased their shares. They're diluting their owners by about 30%, okay? So number 6 has to do with long-term debt. We want debt that's low, that's manageable. So what I've decided that worked for me, that I put in my 8 pillars was, I want to take the 5-year average free cash flow, multiply it by 5, and I want our total long-term liabilities to be less than that number. So we go to our main page, and the 5-year average free cash flow is right here, $120 million. We multiply that by 5, that is $600 million. I go to our balance sheet, and I scroll all the way to the bottom. Long-term liabilities, $1.3 billion. Massive X. It's over double we want it to be. But again, remember, fast-growing company, so their free cash flow is probably going to be a lot lower than it should be. So I'm not as concerned about that. I know that sounds crazy, but remember, a growing company that has a lot of growth potential, that they're spending a lot of money in order to grow, should be given a little more leeway in some areas, okay? And I think this is one of them. Pillars number 7 and 8 have to do with free cash flow. So remember, guys, free cash flow is cash from operations less your capital expenditures. You can buy back shares, pay dividends, pay down debt, reinvest back in yourself, and make acquisitions with free cash flow. So I'm going to look at it by going to our free cash flow statement. I added this line here, and 5 years ago, they had negative $31 million. Last year, $58 million. Check mark. So as you can see, they had free cash flow, even though they had an earnings loss of $1.9 billion, because their $1.75 billion loss was a discount, was a write down of some sort of asset in all likelihood. It did not affect the cash flow state. So they did have an increase in free cash flow. And our final metric is we take the 5-year average free cash flow and multiply it by 22.5 to get some sort of value for the company. So 120 times 20 is 2.4, plus another 240, 2.65. Yeah, roughly $2.65 billion for a market cap. We go back to the main page, and what's the market cap? 44 billion, massive X. So guys, if this was a lot of math for you, and I very quickly, I get it. But there's going to be two other companies we're doing here. And by all means, please rewind to check out what I did here. But here's our actual 8 pillars, so you don't have to sit there and waste your time doing all the math. Very few checks, only revenue and cash flow increase. That doesn't worry me, because remember, we're going to use our stock analyzer tool to determine what to pay for the company, because every investment is the present value of all future cash flow. And since the future is uncertain, we have to make assumptions about the future. So when people are buying a company that I might consider overpriced, their assumptions are probably a lot more optimistic than my assumptions, right? So we have to sit there and use those assumptions to determine a price. All right, so here's a stock analyzer tool. I'm going to start with a 10-year analysis because I do think Shopify does a great job and will be around for 10 years. Revenue growth assumptions. Let me go to the analyst estimates on our website. Look at their revenue growth assumptions for the next 5 years, well into the 20% range. So on stock analyzer tool, I'm going to be conservative here. I'm going to do 10, 17.5, and 25. Profit margin. Now, here's the hard part, guys. We don't know what the profit margin is really going to be. I'm going to go 5, 10, and 15. Free cash flow, I'm going to do the exact same thing because over long periods of time, free cash flow and net income should be very, very similar. Finally, for PE. Now, PE is at the end of our 10-year analysis. It's going to grow a lot more. The faster it grows, the more it grows, the lower the PE should be because there's less potential growth there. A larger company is less likely to grow as fast as a smaller company. So I'm going to go with 14, 18, and 22. I'm actually going to be very aggressive here on the high-end PE because hopefully they get higher margins, they get higher growth potential, they expand into other areas, and they have a moat of some sort that justifies a high PE. And finally, for my desired return, I'm going to do 12.5, 15, and 17.5. And the reason being is on the low-end estimates, I'm probably being too conservative, very conservative, so I don't mind a smaller discount rate and smaller margin of safety. But on the high end, I'm being very, very aggressive. So I'm going to put in a much higher discount and margin rate, margin of error. I want a higher margin of safety. That's very, very important when it comes to investments, especially as I make more aggressive assumptions. I hit the analyze button. You're going to get 6 numbers below. So on the high end, it's not even there yet. And these are pretty aggressive assumptions, I thought. Low end, $4. High end, 32. Middle range, about 15. So to me, I'm going to move on from Shopify and say, you know what? It's not part of my system, but I might add it to my watch list at $20 and say, you know what? If it gets there, I'm going to do more research, see if the fundamentals got better. So the next 2 companies we're going to go to, we're going to do it a little bit faster. Tyson Foods, not as exciting as Shopify, not growing as much, but the stock is currently at 76. The 52-week high is 100. 52-week low is 72. So let's go right to the 8 pillars tab. All right, so low ROIC, which makes sense because really, what are they reinvesting in? I mean, it's not like a tech company where there's a lot of investment opportunities. A little bit more debt, which doesn't concern me because Tyson Foods is a very, very reliable business. So they might be okay on that front. Free cash flow is down. It's down quite a bit. So speaking of free cash flow, last 5 years they did $2 billion. Last year they did 1.4. So look at this. We have a dividend yield of about 2.4%, which is almost double the market. Now the key here is they pay out $650 million in dividends, which is great. And more importantly, they can easily afford it. So that's the key here for dividends. Make sure the company can easily afford it by comfortably paying under 50% of their free cash flow in dividends. All right. Low multiple, 5-year PE of 10, 5-year price to free cash flow of 14. All right. So let's see what the analysts are saying right now. The analysts see, kind of poopy, drops in EPS, even with very low revenue growth. All right, let's go to stock analyzer tool. So revenue growth is very little. So I'm going to go -2, 0, and 2. Profit margin, as you can see here, the profit margin is a lot higher in the last year than historical. So I'm going to take that down a bit. I'm going to go 4, 5, and 6. Free cash flow margin, I'm going to do 3.5, 4, and 4.5. PE, I'm going to go 8, 11, and 14. 8, 11, and 14 for free cash flow. And for here, on my desired annual return, I'm probably going to do 12, 14, and 16. Analyze button. All right. Low end, we have around 40. High end, we're actually there on the earnings multiple. So you can get about a 16% return if all these things come true, 60 to 80. Low end, 50 to 60. So it's pretty close. So if I were you, if you're interested in this company, go do more research so you can sit there and make sure that your assumptions are correct. Best way to do it, join our community. Our community is very wonderful. It's a great way to get ideas from other people. There are thousands of people in there every single day doing research, and I'm sure somebody has talked about Tyson Foods, and if they haven't, they'll probably have input on it. And you can also get the 10K from our software. It's a no-brainer, less than a cup of coffee. Check out everythingmoney.com. Final stock, 3M. So let me pull up 3M here. Boom, 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 boom. Okay, the stock's at 125. The low was 116. The high is 188 for the last year. Now let's go to the 8 pillars tab. First off, huge dividend, 4.8%. That's a very attractive dividend. But keep in mind, it pays out $3.4 billion of their free cash flow. 5-year average free cash flow of $5.4 billion. So that's 60% of it roughly. And last year's free cash flow was 4.3. So what is that? 80% of their free cash flow? That's a big chunk. All right, I don't feel comfortable with that. Does that mean they're going to cut it? No. But if they start to do something else, if they start to feel a little bit of a tightness, they're probably going to cut that dividend because it's already very healthy at 4.8%. All right, so the only 1X we have as net income growth for the last 5 years is down $260 million. Okay, that could be for a number of reasons. That could be, let's go check it out. Let's go check out the income statement and see. Was there some sort of other income? No, just happened to be lower. It's a very consistent profit business. Look at the last 10 years. 4.5, 4.8, 5, 4.9, 5.4, 4.4, 4.9, 5, 5.9. I mean, it's a very consistent business. So the great thing about consistent businesses is you probably know what's going to happen. The bad thing is you don't get the growth. So if you don't have the growth, you have to pay a discount to get your money through dividends, share buybacks, and paying down debt. Eventually, the value will come out. So let's go to the analyst estimates. Oh, wow. Look at the EPS. Slow and steady, low single-digit growth over the next 5 years. Revenue, very low revenue growth. And guys, keep in mind, these are only 23 analysts and 24 analysts that our data feed gives us. There are hundreds, I'm sure, of analysts who cover 3M. So make sure you do get other people's opinions on it in that regard. So let's go to our stock analyzer tool. All right, revenue growth. I'm going to do -2, 0, and 2. Profit margin. So last year, profit margin was a lot lower. I'm going to do 13, 14, and 15. Free cash flow, I'm going to do 14, 15, and 16. PE, guys, very low. 9, 12, and 15. I gave it a higher PE with negative growth because it's 3M. They're very diversified. They are a staple in the U.S. economy. I don't think they're going anywhere, so I'm going to pay a premium for that. 9, 12, and 15 there. And guys, I'm going to assign this. 13, 12, 13 and a half, and 15%. Stock price, low side 60, high price 100, middle price around 80. So guys, if you like this video and you want to understand more about margin of safety in our process, please watch our next video about margin of safety and don't forget to subscribe to our channel. Thank you very much for your time.